So what's forex trading? Let's start by defining forex. Forex is foreign exchange. It's short for foreign exchange. So it's more like you're changing your own native currency for a foreign currency. It's like when you move from your country to another nation that's foreign to yours, you can't use your native currency in that country. You'll have to exchange your native currency for the foreign country's currency. Basically, forex trading is like that, but in a more complex fashion. In forex trading, you have a market structure that you'll have to analyze using fundamental means or technical analysis using indicators, price action, using you'll have to have chart patterns, you'll have to have indicators and so forth for you to analyze price action. So on this one, you can't just do it by just opening your markets and then you start exchanging forex or you start trading. You'll have to at least go through some lessons, some courses that will get you educated and that will get you the information that you need for you to be able to analyze the market. So this is what we're about today. This is what I'll teach you today. This is what I'll give you a heads up on. So stay tuned and just keep watching for more information. In simple terms, a market structure is the way that the market appears. This includes chart patterns, candlestick patterns, and the prevalent market trends, as you can see. Now that we've gotten a better understanding of what the market structure is, let's get into the market trends so that we know when to enter and exit the market, so that we see in picture form what the market really looks like. Other things like candlestick patterns and chart patterns will be dealt with in my other videos, so you'll have to watch out for those. Otherwise it will be a very long video. So let's get back to doing the first thing that you will see in a market. A market has four types of trends. The first one is an uptrend. In uptrends, you see your market, your price action moving in an upward manner. So the price forms peaks and troughs. You can actually join the troughs because the price will be making higher highs and higher lows. So when you join those troughs, you form an upward trend line. And you can actually use that trend line for entry points to enter your market when you're taking your trades. But when you're using this trend line, remember, you have to have other confluencers. Other confluencers like demand zones, candlestick patterns, other chart patterns that you can use to enter the market. Don't just enter because you just saw it, go towards a trend line. So this trend line is also what we call a moving demand zone, because as you can see, price hits it, goes up, price hits it again, goes up until it breaks that structure. The other market pattern or another market trend, the second one, is a downtrend. As the name suggests, price moves in a downward manner. It moves in a downward fashion. Price progressively moves down, accumulates, moves down again, accumulates, moves down, even as it forms a downtrend. You can actually see price movement showing lower highs, lower lows, lower highs, lower lows, as you can see on that chart pattern there. Then you can actually join those peaks to form a downward trend. Even as you form that downward trend can also be called a moving resistance zone or a moving supply zone. As you can see, price, when it hits it, it can just make a manipulative move and then it comes down. So you can use that to enter your market as well, but you'll have to take care and have other confluences like other horizontal resistance zones, chart patterns that you can use, candlestick reversal patterns. Don't just enter because you see your price just getting to your trend line. At times you can break the market structure and start reversing and start changing direction. So that's one thing that you can see in a market that forms a market structure. Another market pattern, another third market trend is a ranging pattern, a ranging trend. In this fashion, in this market structure, the price bounces off between two zones, the resistance zone and the support zone. So you can see that price moves in a sideways motion. It moves like it's coming from one point to another point. In this structure, the price hits support, then goes to resistance. So you can actually place your trades on the support or on the resistance, or you can wait for a pullback after it breaks that structure and it hits again any of the two zones. Then you can take the trades if the break of the structure is genuine, because at times there can be a false breakout and you might think that the structure is broken whilst it hasn't been. So watch out for those manipulations as well. A choppy market. Oh, this is the last one that we're doing on this market structure patterns or market structure trends. A choppy market, that's a noisy market. It's also known as a noisy market. You know, price doesn't even have any direction at all. It's not even showing whether it's going down, it's going up, it's moving up, sideways. It's just not showing anything at all. So what you need to do on this one, you need to close your platform and stay away from this type of market, because you'll lose your money. So on this one, we don't trade this one, we just watch it and just leave it be and just wait for a proper market pattern, a proper market structure. So that's it from me. I hope you enjoyed this and I hope you got something and I hope you learned a lot from this. So remember, Rome was built in many days. So you'll have to practice this. This is your homework actually. Just go to your chart patterns, just go to your market, your trading platform, and search for these trends. See how they are playing out and see how to draw trend lines. See how you can enter and exit the markets using the chart patterns. So until next time, keep practicing it.